Hi, class. Good afternoon, good evening, depending on the time of the day that you are or the night that you are accessing this recording. Today, we are looking at managing working capital, which is our learning unit 3. And we will indeed focus on three things: the working capital management, the relationship between risk and reward, and also the cost of money. In our learning unit one, we did touch on the role of the financial manager, and one of his duties is ensuring proper management of the working capital. Proper cash flow is required for any business, and without that, a business cannot buy new inventory for resale or will not be able to pay its debt. You now understand why I am using a scale so as uh, s- to picture that it's all about proper balancing of current asset with current liability to ensure that the business makes the maximum amount of profit. All right. Also, there is cost implications when we take out a loan or we make an investment. Therefore, we will also look at how to calculate the effective interest rate and also the approximate annual percentage rate, APR and E, uh, AR, EAR. It is also important to point out that half of a financial manager's time is spent on managing this net working capital, which is the difference between current asset and current liability. So if you picture the operations of a business, right, when you're looking at current assets, it represent those assets that will move from one form to another during the course of the operations. So, as stated in your textbook, it is in fact that idea that there is a cash cycle, right? And that there will be a transition from cash to inventory to data and back to cash. You would understand why I have illustrated that cash cycle in red. So it is quite important for a business to transform or to turn their illiquid current asset, and I repeat again that illiquid, not liquid, so not cash. Whatever current asset that they have that is not cash, they want to turn it into cash. And the faster that transition, the more efficient and successful the business will be, right? So we're making sure that we are talking about current asset. We are not talking about non-current asset. The same on the other side of the scale, there's current liabilities, right? Current liabilities are debts that needs to be settled within a year. So logical that current liabilities are settled with current assets. You are not going to take or sell off the equipment, the vehicles, machinery, furnitures, land, building, which are non-current, in order to settle short-term debt, right? So you want take long-term asset to settle short-term debt. Yeah, so one certainty here is that we know when we have debt, when we need to settle those debts. It is predictable and we know when the payment is due, right? What we don't know, and no, not what we don't know, what is difficult to predict will be the cash inflows, right? The conversion of the inventory or the debtors to cash. So, in essence, you can say the working capital management, especially the management part, is just ensuring that the business is liquid, ensuring that the operating cycle run smoothly, right? So that is your primary objective um, in the working capital management, right? The secondary objective of the working capital management is to optimize the level of working capital in order to find a level of investment in working capital where the return generated and the exposure to risk is finely balanced. I expect all of you anyway to have a read of this, but what this means, in other words, the optimal level of working capital is not too high, because a high working capital means that the business is buying a lot of inventory on credit, which subsequently could bring high interest cost. And a low level of working capital has the high potential risk of running the business into inventory shortages. So the risk and the return need to be properly balanced. The third objective will be to minimize the interest rate or the cost of capital. Interest rate, another word for cost of capital, needs to be minimized. We should be able to obtain capital at a cheap cost. And in essence here, we need to be able to finance short-term asset with short-term liability, or the short-term asset must fund short-term liability, and long-term asset must fund long-term liability. Actually, the other way around. So when we obtaining the funds via debt, we need to use short-term debt or short-term liability to fund short-term asset. There's a bit of a mistake there, but it's also true that when we need to be able to cover the short-term liabilities, when we are unable to pay, we would obviously sell out short-term asset to be able to repay those short-term liability. So it could be vice versa, but what is to be understood is that short-term debt should be helping us to finance short-term asset, and the long-term debt should be there to help us to finance long-term asset. And here is the sort of final objective. We need to be able to get a return that is higher than the cost of capital. So it is the objective of the business to invest into projects that will return uh, a profit that is higher than the cost of capital. The relationship between risk and return or reward is a very important one in finance, and it is a principle that you need to be able to understand at this stage. From now on, you will be accustomed to the phrase, the higher the risk, the higher the return. There is truth to that. And the lower the risk, the lower the return. There is this ratio, the working capital ratio. It is a ratio that helps gauge a firm's profitability and its risk profile. So what we find is that when this ratio is high, it is a good thing because we understand that the current assets are able to cover the current liability. So the current asset is higher or greater than the current liability. So this eliminates the risk of insolvency, or the firm being unable to settle its short-term debt. So that's a good thing. But on the other hand, it could signify that the firm is not a very profitable, especially the higher this ratio is. So it could be an indication that the firm is not having a good inventory turnover. So, in other words, they are not selling enough and often. A business can have quite a low uh, um, working capital ratio, but that business is highly profitable because of the fact that it is having enough turnover, inventory turnover. So the graph here is quite a useful one. You can see the two axes, the return axis and the risk axis, and you can see that the higher the risk, the higher the return, and the lower the risk, the lower the return. So let me emphasize here that the risk um, is beneficial for a company, especially or for example, when we take more inventory on credit and we run a smooth business that convert that uh, inventory into cash. So that could be a good news for the company that the company is highly profitable, is very good at what they are doing. So they took the risk, which is in the form of taking more inventory on credit, but they managed that risk and converted that credit into cash and profit. So now let's quickly move on to overtrading. Because although we welcome that risk, but there is also a pitfall, which is the danger of overtrading. So a business can be growing too quickly, too fast, to unfortunately the detriment of its net working capital. So that business will be buying more and more on credit in order to increase sales, but it will start now having difficulties selling that merchandise or collecting the cash from its debtors. And in practical terms, we can see what that negative effect is. And you as a student should be aware because we spoke again in learning unit 2 about the data collection period. So if you remember very well, we touched on an example where when the data collection period is greater than the creditor settlement period, that's a danger. So cash that is received timeously from the credit sales is very important. So we need to ensure that the data collection period is less than the creditor settlement period. Now, enough with the theory part. We need now to go into the practical part. So example 3.1 shows you exactly that. So it's an example that shows you two scenarios, right? The scenario number one deals with constant sales. We would assume that this particular business does not want to take risks of taking inventory, more inventory on credit, right? So scenario one, if you go through it everything is constant. You can see the sales is constant, the cost of sales is constant, the gross profit is constant, even the expenses are constant. The net profit is constant, right? And when you look at the opening balance of the month of March, because we're running March, April, May, June, if you're looking at the opening balance for the month, it's 200,000. The movement during the month, because we had an expense, if you look just upward there, the expenses paid in cash was 40,000. So the movement during the month that we're going to record is that 40,000 there. So 40,000 will be minus from the opening balance, which will give us a closing balance for the month of 160,000. Now, that closing balance for the month of March will become the opening balance for the month of April. All right. Closing balance for the previous month becomes the opening balance of the following month. All right. And as well, that 40,000 in expenses that was paid in cash is still reflecting. So we have the expenses paid in the movement during the month of April. You can see that 40,000. That 40,000 will always be there for April, May, and June. But if you can see, there is also a creditor settled in cash. So 120,000 was settled in cash, right? So we can see the creditor there, and that creditor is linked to the actual cost of sales. So we understand that the cost of sales that we have there, we bought things on credit and we are repaying the creditor. We are giving back their money. So since we are settling the next month, we can understand that it's a 30-day period. So the creditor gave us a 30-day to the company to settle, right? So the same thing will happen, therefore, for March will be settled in April, April will be settled in May, May will be settled in June. You can see clearly there, it's quite logical, right? But there is an addition now when it comes to the month of May. When you're looking clearly at May, you will see that there is cash receipt from data from datas. And this is a problem, don't you see? Because we're settling our creditors within a 30-day period, but our datas we are collecting from our datas within a 60-day period, right? Which, as you can see in June, there is a closing balance of 80,000, right? So I can understand why such a company would want to do something, right? So scenario number two will touch exactly on that. This one, there was a little bit too much. I did put too much heroes. So, but the same scenario, the solution to the same scenario is just next to the first one. And if you open your eyes again, clearly you can see. And I want you, as my students, to be able to pick up these things very quickly. What you're picking up is the cost of sales. It has increased. So from March, remember the previous scenario, everything was constant, but now we can see an increase of the cost of sales from March to April, April to May, and May to June. So what we can understand is that the company wanted to increase, right? Uh, it's uh, it's um, uh, it's credit inventory purchases, right? So they're taking more inventory on credit. All right, so we can, it's a good thing, but it's a risk, right? So, but what we found is that the same thing would apply. Remember that the inventory that is taken on credit is settled. So the creditors settlement period is 30 days. So for March, what we took in March, we will settle it in April. What we took in April, the 144,000, we will settle it in May. And what we took in May, the 216,000, we will need to settle it in June. Okay? So same principle. But we still have, right? Correct. You can see that even our sales increased as well because now we went for 200,000. If you remember, scenario one was constant. Let's go to scenario one. As you can see, the 200,000 was constant, but now it has increased because we increased the cost, our purchases, right? Our sales as well increase. So we can see we have an increase in sales from March to April. It has increased April to May and then May to June, which is good, but we still have that collection period of 60 days. If you see that's 200,000 in sales we got in March, we only getting the cash from our daters in 2 months after. So March will come in May. So you can see cash receipt from creditors is that 200,000. Well, so meaning that from this period, when we go to June, the closing balance of June is zero, which is a problem. All right, which is a problem. So in this case specifically, as you can see, it is a problem. It is the problem that we were talking about, the negative effect of having a data collection period that is greater than the creditor settlement period. So you as a student could be just asked how to solve this problem. Very simple. What will you do to minimize that risk? All right, so you will need to manage the working capital effectively and avoid overtrading. What you could do is to obviously ensure that the collection period is greater than the settlement period. So the data collection period, it should be greater than the creditor's settlement period. And this example here deals exactly with that. So with Ben Moore traders, you have this discussion of either keeping the data collection period to 60 days or to or in this case to extend either to extend it to 60 days or to keep it to 30 days. For example, in this particular example, and you can compare the two, whether we keep it constant or we extend in order to boost the sales revenue. So in your practicals, use this example. Try to do it by yourself to make sure that you understand these principles on paper so that you can compare. You can compare where there is uh, um, different periods, whether it be collection or settlement period. So in scenario number two here, you can see that the increasing the collection period caused a rise in the expected sales. Yes, of course, there is a rise in expected sales. And it seems like at the end of June, the balance, the closing balance, it's still positive. So this company's decision to increase the collection period from 30 to 60 seems to be working out for the objective that they had of increasing the sales over that period. So but still for a business need to be smart. So now before making that decision, because we are looking toward the future. When we're making that decision in the present, we need to be looking toward the future to say, if we make this decision, what will be the repercussions of this decision to, to our revenue and profits, right? So that's why what the company would do would need to work smart in scheduling a budgeted or expected returns over the months, right? So this is quite the reason why we will look at example 3.2. This is a good example of looking toward the future with regards to future uh, receipts from our daters, right? The daters are expected to pay their debt in a certain way. For example, we could decide that uh, s- for this example, for this example, as you can see, is that 70% of the debt we intend to collect it in the first month, 20% of the debt we intend to collect it in the second month and 7% in the third month. And there is a reason to this because businesses must be flexible, right? As a business, it must not be as rigid as we need to collect everything in the first month, right? So you must remember that you are dealing with different datas and they all have different um, capacities to settle the debts, right? So then what could happen is that a business could make a policy in place where they would have that flexibility of how they're recouping the money from their debtors. I love this example because it's very practical, it's very easy. They told you what you would get in the first month. So for example, um, we are provided for January. So you know that in February you would need to recover 70%. Um, um, and the next 20% of that 120,000 will be recovered in March, and then the following month you will be able to recover only 7% in April. Right, it makes sense, okay? And what they provided you in this example, they provided you for October, November, and December. Why is that? Is because you need to look at those three. October 2025, October 2025, 70% will be recovered in November, 20% will be recovered in December, and then only 7% for October 2025 will be recovered in January 2026. All right. So then you can see there, and I've put all the errors there to show you that for October, they're recovering in January. Because remember, on this table that you see here, this table is very important. We only have a period of recovery from January to June. So as far as October of last year is concerned, we will only be dealing with that 7%, final 7% that had to be recovered 3 months after, which will fall exactly in January of 2026, right? So that's why it's there. But for November of last year, we will have the 20% that will fall in January, and the following February will recover that 7%. And for December, ah, then we will have the three periods we will have for the 70% in January because it's December, the next month is January, and then the following February we will recover 20%, and then in March we recover 7%. For January, all right, remember January, this is the amount that was there. It was budgeted 120,000 on credit, right? 70% of it will recover in February, 20% of it will recover in March, and the 7% will recover in April. I have put all the arrows to show you so that you know exactly what you are looking at. And thus, these will always come in your assignment and in your exam. So it's good for you to practice this kind of things. Practice to understand this kind of thing. And question 3.2, as you can see, the same thing here is you can see the solution to it. It is here. You can see the solution to it for 3.2. So I will leave it to you here to continue with these examples and to understand them and to practice it. Remember, you also have the solutions. I've shared with you in the extra material on one note. You have the solutions to this. You can check. I will move quickly to the cost of money because for time's sake, let's move quickly to the cost of money. And when we are talking about the cost of money, we are talking about the interest, obviously, right? So you need to understand that we borrow from banks, and these banks also borrow from the South African Reserve Bank. So, when in the context of South Africa, a SARB or the South African Reserve Bank is the bank that lends to all these other banks, these commercial banks we have, such as FNB, ABSA, Nedbank. They all borrow from the South African Reserve Bank, and they borrow at the repo rate, what we call a repo rate. So the South African Reserve Bank offers this capital to the banks at the repo rate, and then what the banks will do to lend to us consumers, you and I, they will add something that we call the prime, which is going to be few percent above that repo rate. So there is even actually an example here. So if, for example, the repo rate is 10% and the bank will add, for example, 3%, which will be 13%. So this is something that you just need to bear in mind. But what interests us here is the to understand these rates. Obviously, a bank can quote you a rate, but there for you to understand really what that means effectively, and like we said, effectively, when they're quoting you a rate, we call that a nominal rate. We need now to find what is the effective interest rate. And as a finance student, it comes now to that point where you need to understand the compounding or the compound effect, which is a very powerful tool because it is to the power, right? It's a very powerful tool of wealth creation or wealth depletion, right? So you need to make sure that whether you are the one who owes or you are the one who is owed money, it could work to your detriment or to your benefit, right? If you are the one receiving the interest that is compounded, it's good, it's increasing your wealth, uh, um, it is to the power, right, of the compound. But if you are the one paying, you will feel the burn somehow. So here is also a good example. You take 1,000 uh, that you borrow to invest, and the interest rate is provided by the bank is of 10% per annum, meaning that is compounded annually. So what is going to happen is that at the end of the year, 10% of 1,000 is 100 rand. So this is what you will need that will be the value of your investment, which is 100 plus the 1,000, it's 1,100. This is what we call the future value. All right. The present value is the 1,000 rand that you invested. All right. The future value of it, because that investment has a 10% interest rate, at the end of that year, the your investment will increase to 1,100. So that will be at the end of the first year. But at the end of the second year, that investment will increase to not only the interest rate on the 1,000, but now to the interest rate on the 1,100. All right. So as you can see here, the compounding works this way. You can see that table there that shows you that in the first year it was 1,000 multiply by 1.1, which is the interest rate, right? The investment plus the interest rate of 10%. 10%, 10 divided by 100 gives you note 0, note comma 1, right? Note comma 1 plus 1 gives you 1.1, as you can see there. So that's why if you multiply 1,000 by 1, 1 comma 1 or 1.1 gives you 1,100. But in the second year, we're gonna multiply the 1,000 multiply by 1 comma 1 multiply by 1 comma 1. So in other words, what we are saying, we're not gonna take only the 1,000 rand interest of 10%, which is 100. We're gonna multiply the 1,100 by 1 comma 1, as you can see. And you can see that that gives you a greater number. And that's the meaning of the compounding effect. So we are getting also the interest on the interest. To put it in simple terms, Compounding effect, it's the interest on the interest. Multiply by the number of years, obviously. All right, so please practice this. It's a very, very important thing you need to be able to practice with your calculator and understand this. So, so when you are quoted by the bank, how then do you when you are quoted by the bank, we call that the nominal, right? The nominal rate that is being quoted to you. So how do you manage to find the effective or the real interest rate, the effective? And this formula is a good formula that you need to be able to understand and to practice with. All right? Yeah, so the formula, you're looking at the effective annual rate or interest rate equal to 1 plus the quoted nominal rate. So the bank quotes you a rate, we call it the quoted nominal rate, obviously in bracket, the quoted nominal rate divided by M, and M is the number of compounding period in a year. In a year. So if they are quoting you a nominal rate of 12%, but that is compounded monthly. So you will have, if it's monthly, monthly means that you're going to have 12 periods in that year. So I hope you understand. So if it's a 12% divided by 12 gives you 1% per month, in other words. Okay? So you need to be able to understand that. So the M is the number of compounding period. If the compounding period is um, uh, per semester, and there's 2 semesters, 6 months, right? Then you understand that you have only two compounding periods. If it is by quarter, it's compounded on a quarterly. So a quarter is 3 months. 12 divided by 3 equal 4. So there's 4 quarters in a year, right? 4 quarters. So you will understand that the M will be 4. So you take the quoted nominal rate divided by the number of periods, and all that in um, parentheses, sorry, in parentheses, 1 plus the quoted nominal rate divided by the number of periods, and all that in bracket, we put it to the power of that number of periods. Very simple, minus 1. What happens here is that students don't practice this. It is a question that always appears in your assignment, and it's a question that always appears in your exams. Guess what happened most of the time? Students did just not have the time to practice this. Even this example that we are talking about here, a very simple example for you to practice, and I've shown you how you practice this, but you need to be able. This is finance. This is not a theory module. It is also a practical module. Take question 3.5 and practice it, because the same way they provided you these questions in your exam, it's going to be the same very thing. So you can see that they've provided you from three independent banks who have quoted you 15. They have quoted you the same rate. But now you need to look at the compounding periods, right? You can see that for REM Bank, the compounding is daily. That's why you can see that 365, M is 365. For same bank, the compounding is quarterly, and then for 10 bank, the compounding is annually. And if the compounding is annually, meaning that there is no change, right? So the effective rate is exactly the same as the nominal rate because it is compounded annually. So 16% will be also the effective annual rate. Okay, but what you need to do is to practice this. You take this example, you practice it, right? And then there's the effective annual rate comparison with the annual percentage rate. I'm going to leave this section for you to read and to also do the exercise, which would be on your Excel spreadsheet. These are important. Why? Because we want you to do this practice as a future entrepreneur so that you know how to do this when you're going to become an entrepreneur, right? So that will be basically the end of learning unit 3. It's quite a short learning unit, not difficult at all, and we've covered what need to be covered. Please make sure that you do your reading and you do also your practicals, you practice, and please get to me if you have any question, just reach out to me so that I can assist you. Thank you.